Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. So it's the 26th of May, it's a Tuesday, so we're a little late this week, but of course that's because it was the bank holiday. Did you enjoy the sunshine?
Had a lovely time, thank you. And you, Karen?
Yeah, very nice indeed. But lots to catch up on again. I mean, we're starting with now what's a pretty familiar story, which is that the Strait of Hormuz is still closed to vessels, and therefore we still are missing all of that energy transiting through from that all-important Gulf region. We're starting to now see the economic effects of this in the data. And yet, despite all this, markets are reaching, once again, a new high last week for the S&P. So what's going on? How do you square the circle, Hugh?
I think a few bits here to pick through today. So we had the PMIs, the business surveys released last week for May, and they painted a reasonable picture, it must be said. But I think there are a couple of takeaways from them. First of all, the US did look somewhat more resilient than the Eurozone or the UK, as we would expect, given their relative levels of energy independence. However, lots of that optical strength at the headline level was coming through manufacturing, and there are some signs everywhere that inventory building, stock building is helping to, dare I say, artificially inflate some of the numbers, because obviously you can only build up your inventories for so long before you then have to slow production if you can't sell things quickly enough. So in the US, actually, manufacturing hit a cycle high of 55.3, while we had the services numbers edging down towards 51. In the Euro area and the UK, things were a little bit weaker. Again, generally, you had that trend of manufacturing a little stronger than services. And importantly, I think for both the Euro area and the UK, you've got employment well below that important 50 levels. So both areas suggesting that, yes, okay, things are holding up all right, but businesses certainly aren't dashing out to be rapidly hiring anytime soon.
And I guess that fed into some of the big moves we saw in bond markets last week. So we had quite a reversal from the trend that was the week before, actually, where bond yields were going up. We had a pretty meaningful fall in gilt yields at the back end of the curve. But actually, it was all across the world, wasn't it? It wasn't anything to do with UK politics. And that is, I suppose, as markets starting to feel a little bit more optimistic, not only about the Iran situation itself, because oil fell pretty substantially last week, and therefore that taking some of the need to raise interest rates off the table. So what was going on in bond markets last week?
Yeah, we had some big moves. We had 10-year yields down by 20 basis points or more in many parts of the world. And I think, as you say, it was absolutely linked to the decline that we saw in oil prices, alongside some more conciliatory rhetoric, dare I say, from politicians around the world. So although yet again, here we are this morning saying that we know there are still challenges in reaching a deal between the US and Iran, I think it's fair to say we're closer this week than we were when we met last Monday in terms of both sides edging towards a deal. I wanted just to touch on some of the consumer data that we had as well, Karen, last week, because it was a big week for corporate earnings. And I think some of these signals are probably more telling than what we're getting in some of the economic data at the moment, in terms of Walmart, Target, Home Depot, Lowe's in the US, all reporting, and all pretty consistently painting a picture of an economy which is slowing, a consumer that's coming under pressure, but two themes really, I think, calling out. Number one is this idea of the K-shaped economy. So higher income consumers faring much better than lower income consumers. And then I thought most illustrative was the fact that Walmart decided basically to eat all of the higher input costs that they saw over the quarter in the form of their margins. And just saying, we don't think we can pass through higher costs to consumers as quickly as perhaps they did in 2022, which I don't know about you, Karen, but to me, it's not exactly a sign of a red hot economy if corporates are having to eat these higher costs in their margins.
Yeah, absolutely. And so I think what we're learning, aren't we, is the consumer is the part of the economy bearing most of the brunt of this and demonstrating that they're a little under pressure. And then that, again, I think feeds into the view that we've said, and I think still are very comfortable, that because of that, this is not an environment the central banks should or will be raising rates. So I still think we're quite comfortable there. I mean, all of this is clearly still, however, unsustainable, isn't it? Because we do need energy prices to come back down for Walmart to regain that profit margin and for the service sector activity to bounce back up. So markets definitely need this resolution, don't they?
Absolutely. And you spent some time last week with our colleagues in the transport team. What did you learn from them?
Well, I mean, we're incredibly fortunate because JP Morgan obviously has a large alternatives business. And so you get sort of a more bird's eye view of what's going on in different sectors in times like this. You know, it kind of reminds me of COVID. There, I was trying to become an amateur virologist. Now I'm becoming an amateur shipping expert. But to sit down with that team, because they manage 130 vessels on behalf of our clients. And what I was trying to gauge from them really was not when a deal might come, obviously that we don't know when that is, but the question of when there is a deal, how quickly can the Strait get back to normal and how long will it take for the whole energy market to normalise? And I do think this is where, actually, I came out of that meeting reasonably optimistic, actually. I think the overall impression they gave me was that they've become incredibly nimble in terms of what storage capacity they've been able to pull in to maintain production. So in other words, there is a heck of a lot of the lost oil that's ready to go. So that's going to be very helpful as soon as the Strait is reopened. But actually, the other thing I found really fascinating was just how fast it's creating different activities. So Saudi, for example, piping across the country to the other sea exit, it's up to around 7 million barrels a day doing that. It's got in place a new pipeline that it's really rapidly working on to sink underground in order to be able to increase that further. And then Qatar, I was trying to also gauge how much damage has there been done to the infrastructure. And therefore, is that going to reduce for a lengthy period of time the supply? And just again, having people with actually numbers, because the headlines, for example, over the last few months have presented that 2 of Qatar's LNG trains, where they create the LNG, have been damaged, and that's going to take 3 to 5 years to get back in production. But that story wouldn't be quite as sexy or quite as eye-catching if they included the information which outlined that actually Qatar have a whole load of new trains coming on stream, 4 of which are supposed to be open within the next 18 months. So I came away thinking, so long as we see this degree of deal, and I think we're learning a bit, aren't we, about where the sticking points are, but maybe how some of those sticking points might just be punted to the back end of negotiation to get the Strait open. I actually think the jury's still out as to whether oil sticks near this 90 to 100, or maybe even does fall back to the 70 to 80 mark as we move into next year. And that would be very positive news.
And I mean, our colleagues in the transport team have had to deal with a few of these different issues over recent years, because it wasn't so long ago we were talking about the Suez Canal being blocked. Obviously, with COVID as well, there were big disruptions. Did they give you any sense of how this one compares, or maybe where businesses have learnt to be a bit more nimble and being willing to reorganize themselves a bit more quickly given recent experiences?
Yeah, well, I think it is the learnings that are similar. High prices act as an incredible incentive to get stuff moving. So the speed with which the situation can normalize when you are pulling your oil out of the ground at $100 a barrel, don't underestimate the power of that in getting all of the producers in the region pumping and getting it out into the global economy as fast as possible. So I think that's point number one. And then, just some of the longer term change that this ultimately generates, whether that is new routes being permanently created or the different energy systems. And I certainly think, to me, one of the reasons that markets are rational to be elevated and looking through this short term is they are understanding that almost the more chaotic the world becomes, the more it generates just more spending by governments on energy infrastructure, military, technology, security, all of these things where we're trying to create our own resilience, where we're not as sure whether we can rely on our neighbours, and more company spending. And I think that's why the markets are thinking, well, yeah, this is a short-term disruption, but this is just going to generate more and more multi-year spending programs, and that ultimately is going to generate growth and corporate earnings.
And I think that's where we start to think about some of those lower oil price scenarios, because when this shock first happened, the message was very much, well, the Strait has now been closed for the first time. Therefore, maybe we should be assuming there'll always be that higher risk premium embedded in oil prices. But certainly, I think from some of your takeaways last week, this is where if ultimately over time, the market starts to see a path to a more resilient and more diversified supply chain for energy, maybe that's where you do open up some of those just possibilities that you can start to think about a faster resolution in oil markets and therefore a bigger move lower in prices ultimately.
Yeah, and I think that's really important. I mean, we've started all of the background work as we think about writing our mid-year outlook. And I think fundamental to our conversation was a question of how fast will cost pressures ease, and therefore how quickly might we get back to the story we were telling at the beginning of the year, which was all about all engines of the economy blazing, whether it was government spending, companies spending, and consumer spending. And that was a big part of the European catch-up story. If you did feel that actually energy prices could fall back a bit more quickly, I think you'd be much more confident about buying the parts of the market that you mentioned before, Hugh. Maybe you could relay them, which are relatively beaten up because they are still nervous about high oil prices and how long this is going to last. Remind us, what are the parts of the market that are still depressed?
Yeah, so this is where you're thinking about autos, airlines, Europe generally, given its higher weight to industrials. I mean, we had Ryanair, for example, out last week talking about having a decent amount of their fuel stock hedged and therefore not too much vulnerability in the near term, but very much needing to see a resolution to avoid disruption later in the year. And then at the same time, we've had the tech story powering on as well. I think maybe before we turn to the week ahead, just a very brief word on NVIDIA, because there we had results last week as well. And I think for me, the main takeaway from Jensen Huang's comments was all about this idea that NVIDIA gets the fact that they can't just rely on hyperscaler spending. And so where are they turning to? Governments. As you say, Karen, a big source of determination to build national security is coming through technology independence and tech infrastructure. And NVIDIA get that and are saying, well, actually, maybe one of the ways that we can diversify our revenue streams is to tap into government spending and more broad corporate spending to ease some of the concerns that I think we and others have had for a long time about just the concentration of their revenues. But maybe we should turn to what's coming up this week now.
Yeah, well, fortunately, given the weather's so beautiful, it's a reasonably quiet week. So let's hope that the situation in the Middle East gives us a little bit of a respite to relax and enjoy the weather. But it's all about Japan this week. And this is actually really important in the global story, particularly in the global bond market story, because we know that Japan has had these decades of deflation, decades of very, very low interest rates, and have been a big provider of cheap money to the rest of the world. But something's happening in Japan. They are definitely getting their mojo back. We've seen more government spending, but a lot of tech spending happening in that region. And they do seem to be back into growth and some healthy inflation. Now, this is where I think the authority makers there, you've got to be a little bit careful what you wish for when you're asking for more inflation, because if the economy really starts to pick up and inflation picks up, the Bank of Japan is still sat there with deeply negative real interest rates, and it's going to have to start moving them. And they're clearly finding that challenging, how fast to move. They don't want to see a rapid yen appreciation. So they've been, I think, trying to calm markets, maintain this idea they're going to keep rates low. But I think for all of us, it's going to be worth keeping an eye on, because if the data get too punchy, then that is going to really suggest the Bank of Japan are going to be forced to move a bit quicker.
Definitely. So we'll be watching the labour market data out this week. We'll be watching the retail sales data out from Japan as well. Obviously, all in the context of a Prime Minister, Takaichi, who's announcing new spending, new support for consumers to help them deal with this latest inflation shock.
We are back to that theme again. More chaos, more spending. Okay, well, let's leave it there then. Hopefully you're all enjoying this beautiful weather out there, but also staying cool. Thanks a lot for joining us. Many of you have very kindly given us a good review. We really, really do appreciate that. please pass on to anyone else you might find useful. I found out there's a whole load of A-level students here that are actually listening as well.
They should be studying, shouldn't they, rather than listening to
us?
us?
But I think this is part of their current affairs, so we'll take it. We'll take any listener out there. So really grateful and wishing you a good week.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.